I'm always on the lookout for an 8 to 12% yield from stocks and funds that don't cut their dividends. Today, we're going to look at 3 income investments that have never cut their dividends, not during the 2020 pandemic, and more importantly, not during the 2008 global financial crisis. Even those of us old enough to remember the 2008 recession have forgotten just how bad it was. Stocks and funds fell more than 50%, and unlike 2020, there was no quick bounce back. The recovery didn't take months, it took years. Today, I want to focus on some positive news from that time. 3 income investments that currently yield 7.8%, 8.3%, and 14.2%, or an average of just over 10%. More importantly, these 3 have one important thing in common. They survived the 2008 recession without cutting their dividends. First up is the Reeves Utility Income Trust, ticker UTG. It's currently yielding 7.8%, and its distribution history goes back 2,000 years to when they built the Roman aqueducts. I'm just kidding. This utility fund is old, but it's not that old. We can knock off 2 zeros. 20 years ago in 2004 is when UTG started paying distributions, and lines on the chart look tiny because it's hard to fit that many monthly payouts onto one page. The spikes are special distributions paid on top of regular distributions. Haven't seen a special distribution for a long time, but that's okay because the regular distribution has grown from 10 cents to 19 cents over that time period. If you think that income growth is a little bit slow, remember that the yield has been high from day one. It's typically paid at least double what dividend growth stocks like, say, Johnson & Johnson pay. If you bought J&J back in February 2004 when UTG began, your yield on cost today would be 9.2%, much higher than the 3-ish% that J&J is yielding today. Why is that? Because J&J has done a great job of growing their dividend. If you bought UTG when it launched in 2004, then your yield on cost would be even higher, 12.3%. It doesn't grow as fast as J&J, but it started with a much higher payout on day one, and it grew from there. How does UTG generate those yields? Well, it owns a basket of just over 60 utility stocks, mostly energy, but also some telecommunications. The income comes from stock dividends, capital gains, leverage, and selling covered calls. If you'd like to learn more about UTG, I'll link to this UTG review in the description, as well as this article from Seeking Alpha that explains how UTG will benefit from interest rate cuts and also AI. I recently made a video about how I use Seeking Alpha to find income investments, so I won't go into it here. There's a link in the description for a free trial and a discount. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. Our second GFC survivor is a business development company, or BDC, Main Street Capital, ticker MAIN. There are 3 things I think you should know about Main. Number 1, it's a great company, arguably the best of the 50 or so BDCs. More about that in a minute. Number 2, it's almost always very expensive and for good reasons. And number 3, the yield might be higher than you think. If you search the internet to find the yield for Main, it's confusing. Yahoo Finance quotes 2%, Snowball quotes just under 6%, and Nasdaq.com agrees with Snowball. Then Seeking Alpha quotes 8.3%. Why the variation? Well, Yahoo Finance is just wrong. I can't explain that one. And the difference between the other 2 numbers comes down to whether or not you include the special dividends. To give you an idea of how important the special dividends are for Main, this chart shows the history of regular dividends. You can see the steady growth in payouts. Then this chart shows the special dividends, or as they call them, supplemental dividends, shown in green. Management's intent is to pay both types of dividends unless there are severe economic challenges, like the pandemic of 2020, and in that scenario, to continue paying the regular dividend. And they have a history of delivering on that promise. I mentioned earlier that Main is expensive, but for good reasons. Those reasons are, first of all, they run a tight ship. On average, BDCs spend 2.8% of their assets on operating expenses. Main is the most efficient BDC because it only spends 0.9% on OPEX. This chart came from Raymond James. If you're into BDCs, they publish a great report, and I linked to the most recent edition in the Armchair Insider newsletter, which also includes my portfolio and my recent trades. It's free. The second reason Main is expensive is that they have a long history of no dividend cuts, which is why they're included in this video. And the third reason Main is almost always expensive is a long history of delivering extremely high total returns. And that's a combination of price appreciation and also dividend growth. Look at Main's total return since inception in 2007. It has crushed the S&P 500 over the long term. And that's not bad for a company that most of the public has never even heard of. The last fund we'll look at today is the Guggenheim Strategic Opportunities Fund, ticker GOF. It's yielding just over 14%, which is pretty high, even for a high-yield guy like me. The distribution history looks like a wall. Not many increases, but extremely consistent over a long period. For distribution charts like this, sometimes I use Seeking Alpha and sometimes I use Snowball, but I mostly use Snowball to keep track of my current and future income, and I can visually rank my portfolio by current yield, I can see yield on cost, and I can know exactly when the next dollar will land in my account. There's a link in the description for a free trial and a discount. So GOF has a crazy high yield, rock solid distribution history. My mind goes straight to where's the risk? This looks a little too good to be true. This price to NAV chart is a big part of the answer. It's priced at a nosebleed 29% above NAV. Their strategy has been to sell new shares of the fund at the premium price, which props up the NAV. That works quite well until it doesn't, meaning if the price fell below the NAV for a sustained period, well then they couldn't issue new shares without harming the NAV, and the NAV would erode quickly. The strategy they've been using has worked since inception in 2007, so I made a small investment just in case they're able to keep this thing a-rolling. Oh, and I didn't mention how this fund makes money. It's mostly a fixed income closed-end fund, and it holds just about every instrument you could imagine, from bank loans to preferred shares. Then it adds leverage and sells options. It's quite the mixed bag. Even though these three investments have demonstrated their ability to deliver consistent income, doesn't mean I'd overweight them in my portfolio. Here's my current take on each one as I record this episode. GOF, or GOF, is a high-risk bet that has paid off for a long time. It's insanely expensive, but its business model has produced consistent income for 17 straight years. I respect that, but it's not a guarantee of safety. 3M increased their dividend for longer than I've been alive, and then in May of 2024, yikes. If an external event causes the price of GOF to fall far enough, it won't be able to issue new units at a premium to NAV, and the business model won't be able to prop up the value. That risk, along with the very high price, is why I only maintain a small allocation of less than 1% to GOF. Now, Main's business model is far less risky than GOF's. They're recognized as the best BDC and priced accordingly. I can't fault the business, and there's no question that it should trade at a higher price than its competitors. It's just a question of how high is reasonable. I chose to take profits on most of my Main earlier this year because the price had gone up so high, I couldn't resist. The S&P 500 has had an extremely good run over the past year, delivering a total return of almost 30%, but Main managed to shoot past 30%. Now, I'm not saying that I regret my profit taking, but I am somewhat torn. There's a strong argument that says just hold Main forever and enjoy the income growth. Most articles on Seeking Alpha will say, great company, but very expensive. The thing is, it's almost always expensive. So if you're a Main holder that doesn't care about the price, I get it. That loyalty to Main has paid off over the long term. From my current vantage point, all I can say is that during the next market correction, Main is one of the first investments I'll be adding to. UTG's pricing is far more down to earth at a premium of less than 1% over its NAV, and historically, unlike GOF, the price doesn't move far from the NAV. Yes, it would be nice to pick it up at a discount to NAV, and occasionally that does happen. I think rate cuts will be good for UTG, but I still like it even without rate cuts. For these reasons, I'm currently weighted more towards UTG than the other two. Before we wrap this up, if you're wondering how these three investments rank against each other for total return, here's the answer. I went back to the furthest point that all three existed, which was 2007, and the clear winner for total return is Maine. In defense of the other two, Maine has been far more volatile during a correction. If you bought Maine just before the 2020 pandemic correction, then there were some very nervous months while the price fell through the floor. So, in summary, if somebody tells you that high-yield investments will be destroyed in a recession, yes, the prices will suffer, but some high-yield investments have proven that they can navigate choppy waters yet still maintain consistent payouts over a very long time horizon. If you'd like to learn more about Maine or UTG, I'll link to those reviews over here. That wraps it up for this look at three income investments that didn't cut their distributions during the 2008 recession. More Armchair Income coming soon.